looking at all these things and weighing it all out. Okay, so we have a balanced price range in here. A balanced price range. Okay, what is a balanced price range? It comes in many forms. I shouldn't say many. It comes in a couple forms. But as I was mentioning earlier in the workshop video today, we have talked about how markets stay in a range. And when they leave that range, because upside and downside has been delivered on price, it makes it a balanced price range. What happens when it's done over the course of a couple candles and not a multitude of candles? Think about it like this. If I was in a live setting, say if I was on a stadium, or not a stage, listen to me, stadium. If I was on a stage, okay, and I was in a room full of a lot of you, okay, I would right now ask by a show of hands, by raising your hand up, and you don't need to do it. I can't see you. I know some of you are going to do it. Raise your hand if you have been in trading long enough to remember what a key reversal is. Okay, a key reversal would be a day where it's like this, and this right here, all of this movement here would be absent from the chart, and you would just see the market would be here one day, and then the next day it would be gapped down here, and then the next day it would be gapped up here. And all of this movement would be invisible. All of this movement would be invisible. It would just be looking just like that, okay? That is a key reversal or a island reversal. Very, very classic, old school dinosaur type of trading. And that is essentially what I'm trying to take your attention to, because that element of separation, that once price goes to an extreme, which is what it's doing here, because see what we have here? We have a low. We run through that low, and we do it on a very large candle. And then we come back all the way back over top of that again. So these two candles right here, this represents a balanced price range because it's reached down to a level, and it's offered on one single pass all this move, and the next candle over here, one single pass. So the way I do this and I define it is this. Which is higher? This candle's low that moves back inside of this up move of this candle, excuse me, this down close, this down movement on this candle eats into this up close candle, but only to this point. This low or this low, which one's higher? Clearly this one. This is the only candle that is defined in the range that this candle goes lower and this candle goes lower. So what I'm saying is the range is from here to here, extended out. Okay, so this makes a balanced price range. All of this in here, I don't care about. I could care less about that. What I'm looking at is this relationship. I'm not sure. It must be the outline. Yeah, it is. So it's the bottom one. Bottom one, right? There we are. So that's the balanced price range here. And what I'm trying to convey to you is that because we had single pass down, single pass up, this is balanced now. Once we leave it here, what that means is this range, you define it by what I just showed you here, the highest and the lowest extreme between both of these up close and down close candles, this entirety of that range, low to high. Where are the bodies of the candles over here stopping? I know, it's some serious shit there, ain't it? That's algorithmic. All the bodies of these candles here are respecting the midpoint of this balanced price range. How the fuck can you go back through any retail stuff and see this being taught anywhere else? It's not. It's not anywhere. These are things that you wouldn't learn by any book. None of that shit exists anywhere. This is stuff that's authorship. So when I'm watching a balanced price range, or if I make mention of a balanced price range, what I'm suggesting to you is that there is a definitive boundary that at which I don't want to see breached on a candle's body. Okay, I don't want to see it move beyond this. In this case, we were looking for what? For dollar, move lower. So a lower move in dollar is what in other asset classes? Risk on. Risk on is dollar lower. So dollar lower, all foreign currency higher, and it gives the freedom for stock indices to go higher. Knowing that the dollar index and index futures are not lockstep. Every point higher is a lower move in this or that. It doesn't move like that. Okay, much like when I taught bonds and the yields, how the yields will move and they'll cause a long-term effect on foreign currency because they're going to chase that yield. But the yields can change, and the delay between all of that shifting in the currency, it's not an immediate thing. Just like commitment of traders, net trader positions. Just because the commercials are net long doesn't necessarily mean it's time for you to go long. So there's rules to all these things, and that's why it's important not just to simply watch one video or one lecture and think you come away with understanding. It doesn't work that way. But when I give a boundary to a marketplace and I code in a limitation of how far the market's going to go, it's limited to a degree of this is how far you're allowed to go. But then the wicks are permitted to do a certain measure of damage, which is what we're seeing right here. The halfway point of that range, nobody's going to look at this stuff here, okay, and define it like that. It isn't anywhere else, okay? I codified this, so I want you to understand that. These candlesticks are supporting the idea of the principle I'm teaching to you. It's not limited to just this. It's happening every time I tell you there's a balanced price range. This is what's occurring. The market's returning back to equilibrium. That's what this is here. Okay, it's not consequent encroachment. It's not mean threshold. It's equilibrium. A balanced price range is going to go back to equilibrium. The bodies in here are supporting that. As long as we don't get any close lower, there is no manual intervention. If it does, there's manual intervention and you abort it. This is just supporting the idea that it's going to go higher. So what you want to see is you want to see the market want to move up, and then create more power 3. Power 3 is open, down, close, rally, close on the high. Open, drop, rally, close on the high. Do we see it here? Drop small, rally, up, close. Open, drop down, rally, come back, still an up, close. So much of a small little movement you can't even barely see it, but up, close. We open, we drop down, rally, up, close. What is order flow? What is the order flow at that time? Is it bullish or is it bearish? Bullish. At this time right here, okay, on this candle's close, on the very next candle, on a 15-minute basis, you can use power 3 on that one 15-minute candle right there. As it opens, it drops down. You can be buying anywhere in the upper 50% of this candle here and expect this range here to stay open. Why? Why would this be expected to stay open? You see this candle right here? This is the same thing occurring here with more candles in between. This is all time distortion. I know, this is too complicated. Fuck this, give me a moving average. I know some of you were getting frustrated because but you want to learn, and I'm willing to teach it to you. But you don't need everything. But I'm teaching you how I do these things. How do I determine when I'm doing live executions? I say this is going to stay open. It's optimal for this fair value gap to stay open. You're asking me to teach you, so I'm teaching you. The same element of delivery here and here, that one single candle right here, imagine this one candle. If all these candles from this candle here to here were compressed into one interval, it would be the same thing happening right there, just more candles. That's all that's happening. So my eyes go into this, to this. So now let's use the same criteria, okay? Which is higher, this low or this low? This low. So there's your, we don't want to anchor it to that, okay? Draw that down. Come on in. I use it's not a mouse, it's a touchpad thing. Which is lower, the high of this candle or the high of this candle? Let me take this off so you can see. Get off. This high or this high? Which is higher, this one or this one? This one. So this high and this, this low and this high is the two reference points. But you want to expand it down. You want a full encapsulation like we did over here for a balanced price range. So this is a lower fair value gap than this one. To what degree? What measures the distinction between this being lower than that one? It's this candle here. In other words, think of it like this. I know what I want to say, I just can't find the words to, they're escaping me. All right, if we were looking at both fair value gaps like this, which one's higher? This one, right? So to identify and map this out, we use this one as the high, and we drag it down to here. Okay, so all of this is a balanced price range. It should never come back down and through the midpoint of that, meaning there would be a small portion of this gap left open. So let's play devil's advocate for a moment. Say it went down into this range. I would not be concerned about it doing a complete closure here because we have this fair value gap and this fair value gap that basically overlap in this range right there. So we have this portion over here and over here. So this creates what? An island reversal. Multiple candles that are segregated from all the movement here and here. So how I internalize it is all of this right here was manipulation, just like all of this is manipulation. So the purpose is to offset existing liquidity for the purposes of anyone that would be profitable once we get above this high. It's all spending time down there to allow offset longs to be taken out. And who would assume that position if they're getting knocked out? Smart money in the market rallies. Admittedly, balanced price ranges are going to be requiring a lot of education, a lot of teaching. Okay, and I promise you that you don't need it, but you asked me to tell you how I know certain fair value gaps are going to stay open, and I'm not hiding it from you. I'm telling you, this is it. This is what I'm doing to do that. Okay.